Sales tax mistakes happen more often than people realize, and the encouraging part is that they can be corrected. But once you uncover a mistake, timing is everything. The sooner you act, the more options you have, and the easier it is to fix the issue before the state steps in. In this video, we'll walk through the 5 major sales tax mistakes that businesses make, why they happen, and most importantly, how to resolve them quickly and correctly. The first major mistake is simply doing nothing, leaving your business completely out of compliance. You've established nexus in a state, but you never registered, you never collected sales tax, and no returns were filed. Here's what happens when this goes unchecked. The liability increases with every untaxed sale. Penalties and interest begin the moment a filing is missed, and the longer you remain out of compliance, the more time the state has to review your account for a potential audit. If this sounds like your situation, the path forward typically involves completing a nexus study to determine where your obligations began, registering and filing historical sales tax returns, potentially working with states through voluntary disclosure agreements, and then collecting and filing going forward once everything is brought current. This is one of the most costly mistakes a business can make, especially if several years or multiple states are involved. But it is absolutely fixable, and acting early gives you far more flexibility. The second mistake is collecting sales tax but not remitting it, and this is a big one. This mistake is the most serious and carries the highest level of risk. When your business collects sales tax from customers, the state considers that money to be their revenue, not yours. From the moment the tax is collected, the expectation is that you will pass it along to the state, accurately and on time. Failing to remit collected sales tax is viewed far more severely than failing to register or failing to collect. If this goes unaddressed, it can lead to significant penalties and interest, collection actions, aggressive enforcement, and in extreme prolonged cases, legal consequences. This mistake needs immediate attention, so you need to get registered with the state if you aren't already, file all outstanding returns even for older periods, and remit the collected tax as quickly as possible. Just remember that a sales tax professional can help estimate your full exposure, manage the filings, and communicate with the state to reduce penalties where possible. Mistake number 3 is registering but not collecting in alignment with your effective date. Every sales tax registration asks for an effective date, which is the date the state considers your obligation to begin. The mistake occurs when a business registers but does not collect in alignment with that effective date. This can create 2 types of issues. The first issue is that this results in too much tax collected relative to your findings. To resolve it, you would either refund the tax to the customers or amend your returns and remit the excess tax to the state. The second issue is that this creates a gap period, which is a period where tax should have been collected but wasn't. To correct this, determine the amount that should have been collected, amend the applicable returns, and pay the tax owed for that period. In this scenario, the business typically covers the tax from its own funds since it wasn't collected at the time of sale. The goal in either case is to bring your effective date, collection behavior, and filings into alignment so all pieces tell the same accurate story. Mistake number 4 is not filing regularly after you register. Once you register, the state expects you to file returns every period, monthly, quarterly, or annually. The state will tell you the frequency. Missing returns can result in penalties and interest, estimated assessments, and a greater likelihood of being selected for an audit. Eesh. Even if you had 0 sales in a period, you must still file a 0 return. It's one of the simplest mistakes to avoid and one of the costliest to ignore. Mistake number 5 is not collecting the correct amount of tax. Tax structures vary significantly across states. Some, like Indiana, have a simple flat statewide rate. Others, like California, use layered rates based on precise locations. Most platforms include native sales tax engines, Shopify being a great example, but they must be configured correctly. To fix this issue, review your platform's tax settings and ensure collection is enabled in every state in which you have nexus. Incorrect tax collection can create unexpected liability, frustrated customers, or filing discrepancies. So this step is critical. So how do you fix these mistakes the right way. No matter which mistake you've made, the path forward includes identifying the issue clearly, determining your exposure, acting before the state reaches out, and fixing the root cause so it doesn't continue. The sooner you address the issue, the more control you have, whether that means reducing penalties, limiting look-back periods, or preventing an audit. Speaking of audits, what do states really look for and how do you prepare for one? Well, for more information on that, check out this video. And remember, when in doubt, always consult with a sales tax professional.